There are deals that are announced, and deals that are whispered into existence. June 9, 1974, Saudi Arabia, no cameras, no microphones, a meeting that reads in hindsight like a founding myth for the modern global economy. The terms were brutally simple. The United States would provide security, weapons, training, a protective umbrella over the kingdom and the shipping lanes that carry the world's energy. In exchange, Saudi Arabia would price its oil, exclusively, in US dollars. A single decision that forced every industrial nation to keep a hoard of dollars on hand, just to keep the lights on. Oil was not merely a commodity anymore. It became the toll booth for global trade, and the toll was paid in green paper. That handshake did not make the dollar strong because the dollar was virtuous. It made the dollar necessary. But 50 years later, the scaffolding under that necessity is being dismantled, not by a dramatic announcement but by quiet alternatives. Currency swap lines, local settlement agreements, new payment rails. A world learning how to buy energy without touching the dollar at all. The silent crisis isn't that Saudi Arabia might sell oil in yuan. The silent crisis is what happens to the dollar when the world no longer needs to hold it in bulk to buy energy. You have heard the rumors about the petrodollar ending. Most people stop there, at the rumor, but nobody explains the mathematical consequence for your savings account, your mortgage rate, your grocery bill. In 10 minutes, I will show you the hidden mechanism behind the dollar's reserve status, the Triffin dilemma, and the chart logic that proves why the dollar cannot glide gently into a multipolar energy market without costing Americans purchasing power. So, if you never buy foreign oil directly, if you never trade currencies, why should you care what Saudi Arabia invoices China in? To answer that, we have to walk through the mechanism that made the US dollar a global siphon. A system so elegant it feels like cheating. Economists have a polite name for it, the Exorbitant Privilege. It means the United States can buy real goods and real labor from the rest of the world, with liabilities it creates at home. Dollars, treasury bonds, IOUs stamped with federal authority. Other countries must earn those IOUs to participate in trade, and then they often reinvest them back into U.S. assets. Not charity, necessity. If you need dollars to buy oil, you need dollars in reserve, and reserves are typically parked in U.S. Treasury securities because they are deep and liquid. This is the petrodollar recycling loop. China buys oil from Saudi Arabia. To pay, China needs dollars. So China sells yuan for dollars in foreign exchange markets or uses its dollar reserves. Saudi Arabia receives dollars, and then Saudi Arabia, historically, has recycled a portion of those dollars into U.S. treasuries and other dollar assets, directly or through custodians and offshore structures, because that is where large pools of dollars go to earn yield and remain liquid. Meanwhile, the U.S. finances deficits more easily, because global demand for treasuries is structurally supported by global demand for dollars, and there's a darker detail inside this loop. When the U.S. expands its money supply, some inflationary pressure is exported, because foreign economies are holding and using dollars too. Demand for dollars abroad acts like an extra stomach to absorb issuance. It spreads the dilution across the globe. Now, think of an arcade. Imagine global trade is an arcade where the biggest game, the one everyone must play, is buy energy. You can't play with your own cash. You can only play with a specific token, the US dollar. So everyone lines up at the cashier, exchanges their local money for tokens, and keeps a bucket of tokens in the back room, just in case. Now imagine the arcade owner can mint tokens at near zero cost. As long as everyone needs those tokens, the owner can live with privileges other players can't. He can play more games, buy more prizes, run a deficit. But now the biggest game in the room quietly installs a new coin slot, and it accepts a different token. Look at the plumbing. If the world stops needing your token to buy the most important commodity on Earth, where do the excess tokens go? They don't vanish. They come home. That is the part the public rarely understands because it's not intuitive. People think currency strength is about national pride or GDP or speeches. It's about settlement necessity, and what happens when that necessity fades. When oil trade can be settled in other currencies, even marginally structural demand for dollars weakens. Not all at once, not in a Hollywood crash, more like an ice shelf cracking from the edges. until one season the collapse is sudden. Now step into the ghost story, the historical parallel that should make Americans uneasy. 1956. The Suez Crisis. Britain, still believing it was an empire, watched as control of an energy transit chokepoint Suez became a geopolitical humiliation. The pound did not die that week, but something fundamental changed. Britain learned that reserve currency status is not a right. It is a function of power, trade, necessity, and credibility. The pound didn't disappear. It bled. It lost purchasing power over time, and its role shrank while the dollar expanded. That is how reserve currencies usually fall, slowly enough to be denied, until they fall quickly enough to be undeniable. Now, why this time is different. Britain lost its empire before its currency fully lost reserve status. It was already shrinking when the pound started to wobble. The United States is attempting the opposite. It is losing aspects of currency monopoly while running enormous debt and deficits, while deeply integrated with rivals who would like the system to change. That changes the risk profile. A currency that loses external demand while its issuing country is heavily indebted can experience internal consequences faster, and there is a modern indicator that resembles an ebbing tide, a signal that offshore dollars may be preparing to move. One such indicator is stress and activity in the plumbing, short-term funding markets, treasury demand patterns, and facilities like the Federal Reserve's reverse repo operations, where large pools of cash park overnight in exchange for treasury collateral. When these plumbing metrics swing, they can reflect shifts in demand for safe collateral, shifts in dollar liquidity, shifts in where money chooses to sit when uncertainty rises. Think of it as a shoreline. 1974 is the high water mark. The tide is out now, and as it recedes, it reveals jagged rocks that were always there. Unfunded liabilities, compounding interest costs, and a domestic economy addicted to cheap imports paid for with paper. If the best-case scenario is a slow bleed, like the pound, what does the worst-case scenario look like when the world builds payment rails that don't need the dollar at all? Now we arrive at the catalyst, the toolset that makes de-dollarization operational rather than rhetorical, Project mBridge. If you haven't heard of it, that's almost the point. The world's most important shifts often happen in technical committees, not on cable news. mBridge is a cross-border payment platform explored and documented by the bank for international settlements. Working with multiple central banks, including China and partners in the Gulf and Asia, it is often described as a multi-CBDC platform, central bank digital currency infrastructure designed to settle transactions directly between participants, meaning fewer correspondent banks, less reliance on legacy rails, less reliance on SWIFT messaging, and crucially, less reliance on dollars as the intermediary. This is how you build a parallel nervous system, not to replace the dollar tomorrow, but to reduce exposure to dollar-based sanctions and surveillance, to settle trade without asking permission. Now imagine the first domino that actually matters. Saudi Arabia accepts yuan for a major oil contract, likely with China. At first, nothing breaks. The dollar doesn't collapse that afternoon. The change is marginal, but marginal changes in reserve demand can have nonlinear effects because the dollar system is enormous and leverage hides in the corners. The multiplier effect comes next. Other nations watch. Brazil, India, Indonesia, anyone who sells commodities, anyone who fears sanctions risk, anyone who wants optionality. They see that the U.S. military didn't intervene because it can't intervene in a contract. They follow suit, not out of love for China, out of self-defense. And then the flood begins, not of oil, of dollars. Trillions of dollars exist outside the United States in what are called eurodollars, dollar deposits and dollar liabilities held offshore in foreign banking systems, used for trade, reserves, global credit. If global trade requires fewer dollars, a portion of that offshore dollar stockpile becomes redundant. Redundant dollars don't sit politely. They search for refuge. And the refuge is the United States, because it has the deepest asset markets, real estate, stocks, farmland, businesses. Anything that looks like a claim on real output. So the dollars come back, not literally shipped in boxes, repatriated through capital flows, trying to buy real things. That is how de-dollarization abroad can create inflation at home, even if the Federal Reserve raises interest rates. you can still have domestic inflation pressure because you are absorbing the world's unwanted dollar inventory. Look at the logic. The dollar's privilege worked because the world needed dollars. If the world needs fewer dollars, the excess doesn't evaporate, it concentrates, right where you live. At this point, some people reach for denial. They say this is a conspiracy theory. It's not. It's strategy. Mainstream financial leaders have openly warned about payment fragmentation and geopolitical reshoring of capital. When the manager of the world's largest asset pools says the system is fragmenting, he's not confessing, he's forecasting. This is the new environment. Multiple blocks, multiple settlement systems, multiple reserve assets, and a United States that must finance itself with less automatic foreign demand for its debt. So what do you do with that knowledge, besides panic? You position not just for inflation, but for currency debasement, for the unit itself losing external support. Practicality starts with a simple rule. If the currency is at risk, you don't only diversify your investments, you diversify your denominators. First, commodities, not as a slogan, as a mechanism. Commodities are upstream of everything. If oil is priced differently, the entire cost structure of civilization shifts. Owning exposure to energy and industrial inputs, energy producers, pipelines, uranium, copper can be a way to anchor part of your portfolio to real-world scarcity. Second, gold. Gold is not an investment. It is a neutral reserve asset. It does not belong to any government's liability stack. It has no counterparty. It is the asset central banks historically turn to when trust between nations deteriorates. Central bank gold purchases have been elevated in recent years, tracked by institutions like the World Gold Council, reflecting a desire to diversify away from dollar reserves. Third, foreign equities and non-dollar exposures. If a weaker dollar is part of the transition, then assets priced in other currencies, especially in commodity-producing economies, can benefit. This is not about abandoning the U.S., it's about acknowledging that if the unit weakens, global assets can be a hedge against domestic purchasing power decline. Now picture the metaphor. A ship in a storm throws out an anchor. If the anchor itself is rusting, if the rope is fraying, the crew doesn't argue about nostalgia. They cut it and deploy a new anchor. Something heavier, something more reliable. When the dollar loses its energy backing and becomes just another fiat currency backed by debt, in that world, who writes the rules, the holder of paper or the holder of scarce reserves? Now the conclusion. The petrodollar was never an economic law. It was a geopolitical deal, security for settlement monopoly, and like all deals, it decays when incentives change. The transition will not happen overnight. The dollar will not die in a single day, but the trend is difficult to reverse because it is being engineered through infrastructure. New payment systems, new bilateral agreements, new reserve strategies, and the cost of that transition is likely to be paid domestically. Through higher prices, higher volatility, and a currency that buys less than your spreadsheets assume. So what should you watch? Next week, not next decade. First, Saudi Aramco capital market decisions. Where do they list major offerings? Where do they raise capital? And in what currency zones do they deepen relationships? Hong Kong versus New York isn't just finance, it's alignment. Second, Project mBridge updates from the BIS. Watch for new members, observers, pilots moving into production. Infrastructure is destiny. When settlement rails exist, usage follows. Third, U.S. Treasury holdings by major foreign holders. Track whether large players, China, Saudi-linked entities, and others are net sellers, or simply slowing accumulation. The data isn't perfect, but the trend matters. Sources include U.S. Treasury tick reports. The files are clear. The monopoly is ending. Prepare for a multipolar world. I'll see you in the next file.